Hey, good morning, everyone. Welcome to another Wealth Coffee Chat. A few of the crew in the house, good morning. Good to see you, Tim. James is there too. Facebook user, out and about. Morning, Alison. Absolutely. Morning, gang. What's going on? Marcus, all the way from WA. Fabulous to have you here, mate. Another one of the gang. Ian behind the Facebook veil in one of the groups. Good to see you, whoever you are. Great to have you here. Do the old warm-ups and intros, as we always do in the show. Jason Witt's my name. Most of you know. But if you don't, if you're brand new, let us know where you are. You might have joined just recently our coaching and mentoring program. Well done. If you have, fantastic. Stu's in the car. Hey, buddy. Good to see you, mate. Fantastic to have you all here this morning. Thought we might talk about something this morning about the idea of the types of investors that are out there. And I saw this one the other day. It was quite cool. I thought we might have a little conversation around this idea. You know, the type of investor, and all of these types of investors actually make money in one way, shape, or form. It doesn't mean all investors who partake in these types of investings make money. These types of investings, I don't even know if that's a real word. But as a property investor, for most of us, we need to really be clear about the type of investor we are, and stick with the plan. But I thought might share a little story before we kick into it this morning. And I don't know if anyone knows. I think I've told this story once before, and it's not my story to tell anyway. But this is a famous story about the race to the South Pole. Has anyone heard of these two chaps, Edmondson, I think, and Scott, Edmondson and Scott? And two different explorers, two different people setting off on the same journey. And think about this. The idea, quite famously, came about many years ago. These two were organising to race to the North Pole. These two were, imagine this, it might be something that we can all take a lesson from, I reckon. As a property investor, we're starting somewhere and we're racing to somewhere, or we want to get somewhere We want to get to a destination that's not that easy to get to. Let's face it, folks, it's not that easy to get to. It's not that easy to be, focused on investing in property, especially for most of us. We have limited amounts of resources, dollars and time and money and effort that we can put into the world of investing. And you want to have a good plan with that. You can spend years, many years, barking up the wrong tree or going down the wrong road when it comes to investing. And, time is something, no matter how much money you have in the future, very difficult, if not impossible, to buy back, right? So think about this in terms of being a property investor. You've got two very famous sets of explorers looking to race to the South Pole, looking to become wealthy from property investing. And they have two different approaches, two significantly different approaches to their reaching their goal. All right. And let's talk about Scott for the first part. Scott, a British explorer, and he and his team decide that their strategy, their goal, their approach to the journey, this race to the South Pole, something quite dangerous and difficult. What they would do is their journey would be like this. So their attitude was, rule one, on days that the skies were clear and it was easy, they would race as fast as possible, go fast and far, right? That was their way of approaching this thing. Okay, so they would wake up, they'd check the weather, and they'd go, right, it's clear, it's good, the weather's good, let's go. And they would go, as far as they can, sometimes 20, 30, 40 miles in a day, and they might go all night, they might do 20 hours. If the weather was, bad or it was a bit rough, they would stay in their tents. They'd stay where they are and wait it out, all right? So they would only get out and about on clear, easy days, go as fast as they can, far as they can. And on the bad days, they'd stay in their tents and do nothing. All right, okay. Let's have a look at Edmondson. Edmondson, and I don't even know if that's how you spell it, but Edmondson. What was their approach? What was his team's approach? Okay, so let's have a look at their approach. All right, on days that were clear and easy days, they would get up and they would march 20 miles. Now, they might do that in the first 3 hours of the day. It might take them 5 hours. It might take them 8 hours. It might take them 10 hours. But their plan was every day, do 20 miles. All right. On bad days, on bad weather, rough days, terrible blizzards, the whole thing, they would get up and they would march 20 miles. They would get up, they'd pack everything up, and they would get to it. And irrelevant of the day, the weather, or the market, or the interest rates, or the banks, or the media, it would march 20 miles every day. Good, bad, indifferent. So, and most of you, or some of you may have heard this report before, but tell me, who won the race to the South Pole? Who won the race to the South Pole? Was it Scott, only getting out and about on good days and not taking it on in the tough days? Or was it Edmondson and his team? No matter what day it was, no matter what their weather was, did the 20 miles. Which one? Who was it, folks? Does anyone know? one or two of you should know. You've probably heard this story before. I love it. Yeah, and it's the tortoise and the hare, isn't it? Really. Well, Edmondson and his team made it to the South Pole and back successfully. Scott, very unfortunately, Scott and his team didn't make it, and they died. So, what can we take from that as property investors? And I like this as a really simple story to get an understanding of. Like, as an investor, folks, irrelevant of what's going on around you, and maybe not irrelevant, but it doesn't stop you from moving towards your goal steadily. Stay focused on the goal. Sometimes you are restricted because of, let's say, capacity or time or whatever it is, not because you're changing your mind, right? The goal is get to the South Pole. The goal is acquire your number of or dollar amount of properties as fast and as safely as possible. Then the goal is to keep them for as long as it takes, maintaining them and supporting them if they need, until they turn the corner and start to maintain and support you. That's the goal. That's the 20 miles a day, folks. That's the 20 miles a day. Get up, do what it takes. Some days it's easy. Some days, the last few years, totally easy. 2% interest rate, 5% rental yield. No brainer. No brainer. It's putting money in your pocket. It pays for itself. Right now, might be a little bit blizzardy out there. Might be a bit more bad weather. A little bit more money that you might have to put into your property. Has the goal changed? No. The weather around you, the circumstances have changed. Yeah. Do you now go, I'm not going to be a property investor. It's not easy anymore. Well, some people do. Some people do, folks. Some people do, right? And I call them the good time Charlies. Right. So let's have a bit of a look at this. When we talk about in terms of time frames as an investor, what does it take? How long does it take to make this work? And this is a pretty interesting one. Andy Fenton gave me this the other day. The idea, if we're thinking, good work, Alison. If we're thinking in terms of the time frames, right? 1 year, thrill seeker, temporary citizen, trader, somebody who wants to be in and out, make a deal. Now, I'm not saying that's a bad idea. Matter of fact, I buy and sell a type of property. You guys know this in joint ventures, small developments. I do that. And many of you guys have joined us in those as well. But that's not my investing. That's not my long-term investment wealth strategy. That's a trading strategy, which is not investing, right? That's a business. Buy and sell is a business. Buy and hold is that you are an investor. Investors own things. Traders sell things, all right? And don't confuse the two. Don't mix up your portfolio with two different activities. You can do two different things, but they're separate in your portfolio. Anyway, look at this, the idea. And this is an interesting one from the stock market, and it relates to the real estate market as well. Check out the gains, and this was a bit of research over a 20-year period, or you can see down the bottom here. That one of the best years ever was a 60% gain. Who would like a 60% gain in 1 year? That'd be pretty sweet, wouldn't it? That'd be pretty sweet. Love that. Okay. And what happens is investors, and especially people who have that need to get the adrenaline and feel the trading, feel the gain, and win. I won because I made some money, right? And they take the cash out. That type of investor gets obsessed with making a 60% gain. The problem, the challenge with that is on the flip side, the largest 1 year gain of the S&P 500, 60%. The largest 1 year loss, 45%. So when you see this in action, folks, it's the swing is massive. 60% gain, but everyone could handle a 60% gain, couldn't they? Like, yeah, I'm a legend, but can you handle a 45% loss of all your capital and assets in 1 year? Right? So probably not. And if you take a 1 year horizon, then that's how it works, right? Oh. So yeah, well, I mean, and like I said, if you've got a good gain, then nothing wrong with that. Now, nothing wrong with taking a gain that's more than you were expecting. The challenge is that when you invest chasing those gains in 1 year increments or 2 year or 3 year increments, that becomes a challenge to the buy and hold wealth and psychology of a property investor. And if you look over there, like the 3 years, and the point is this, team, is what I wanted to show you down here in this 15 to 20 year section. If you look at the worst performance and the best performance over a 15-year holding selection are in positive territory. It's in positive. And over a 20-year, the worst and the best are in positive territory. Now, that, for me, leaves a bit of a clue if you are going to be a buy and hold property investor, right? How does it play out in the world of property? Well, let's look at this. And this is the idea of, let's say, a 15-year holding journey. And if you had a compounding growth rate of 5%. Now, we all know it's not linear. We had some pretty significant gains in the last few years. And maybe it gets a bit flatter depending on where you are. But if you look at this, if your property had a 15-year trajectory when it came to its value, the first 5 years, value or capital growth purely, it's only 21%, right? 21% of the value that you're looking to achieve only happens in the first 5 years, right? If we look at this as a linear calculation. Second 5 years, again, only sort of 26%. So you're 10 years in and you're like, whoa, it's not going as fast or as big as possible or what I was expecting. And then the final 5 years, because of its value, its compounding process, 53% gain. So the majority of the wealth, folks, is created in the later part of the investment strategy time frame. That 15 to 20 year hold time frame, compounding, is where the majority of the wealth is often created. Anywhere before that, those sort of first, call it 7 to 10 years, are the harder times. There's the harder time to hold the property, the harder time to go the distance when it comes to the ownership, the belief that you're going to make it. Is it worth it, et cetera, et cetera. And I get it. It's pretty tough when you're saying, all right, I used to have this property that was neutral or positive, and now I have to put some money into it. The conversation is like, oh, that's not great now. Well, for me, for you, my encouragement is to say over a 15 to 20 year period, you might have to put some extra cash in to cover some of the expenses at the moment. That's not going to last forever. We know the rents are going up. We know the interest rates will come down a little bit in 24 and 25. That's part of the journey. That's part of your wealth over the next 20 years, right? So the wealth is in the last, or not the last, the 15 and 20 year section and to 30, not in the first 5 to 10 is really the conversation. And it's something I always bang on about, but really it's important to understand. And the other part of today is like, maybe the weather's a bit rough out there at the moment when it comes to the interest rates and a few bits and pieces. But listen, don't muck around. If you can and you've got capacity, you should be finding some properties to buy and continue to move forward. Irrelevant of the environment around you, it shouldn't stop you from your goals. You might just change your tactics a little, understanding how to buy it in a different type of market, but don't stop the acquisition part of your strategy. Folks, that's probably the takeaway, to be honest. Let's be honest. Anyway, there you go. Are you going to be the get up each day and the 20-mile march? You're going to continue to move towards your goal, adjusting the tactics where necessary? Or are you only going to get out of bed when there's good times and, when it's a bit hard, not bother? I know who's going to get the better outcome because I've seen it. I've sat down with thousands and thousands of investors and heard their stories and also seen their stories unfold when they follow the buy and hold strategies and use the right things. All right. There you go. Yep. That's right. That's right, Marcus. This thing's a marathon, not a sprint. It takes time to build it. Good to see all of you on. Thanks for joining me this morning. Almost pretty well done there. We've got someone is just asking about the JV. I think thanks, Dave. Good on you, mate. Appreciate the shout out. The joint venture the other night was predominantly for wholesale investors. I do know that Brennan was working with our licensee for them to find out if we can work with retail investors as well. They've got a way. They've got some license stuff that they can do that with. So whoever that is, shout out to your coach, and we'll keep you in the mix. Just make sure we can get you the info that you need. There you go. Where are we? Paul, why are some banks raising interest rates in July? Seems like they don't care. Well, they don't, Paul. They don't care one bit. And unfortunately, that's a bit of a bummer, isn't it? If you're with a bank and they're putting interest rates up on you folks, then right now, team, right now is a great time to actually refinance and reset your mortgages, because new loans are actually way cheaper than existing loans, and they're gouging, and they're really just gouging, and they don't care, Paul. So, we should all vote with our feet, Paul. Take your business, go talk to your finance team, and get a strategy going. About, I think it was like 3 to 4. Paul, go put a comment in the Facebook group, in the mentoring group, and ask the team to tag you on the training we did not so long ago about refinancing and negotiating with your banks and getting your interest rates down. That was a beauty. So the team did a great training on that. So it would be well worth going watching it, Paul, as you go along. So, all right, team, that's it. Wealth Coffee Chat done and dusted. Thanks for joining. Good to hang out with you guys. Join me tomorrow if you're up for it, for another one. We'll see what we can do, where we get to chat and talk about what's going on in the marketplace. All right, team. That's it from me. You guys take care. Bye for now.